Nick and I are going to take a look at long-term care, and we'll be answering questions such as what is it, why we need to know about it, and what is asset deprivation.
Hi Helen. So can you kick us off by telling us what long-term care actually is?
Of course. Long-term care is where individuals need to engage a variety of services which help them meet both the medical and non-medical needs in respect of chronic illness or disability. So those who cannot care for themselves, so individuals whose health deteriorates to the extent they cannot live independently. And it tends to be the elderly and infirm in the majority who need long-term care, but it can apply to any individual who needs assistance.
Okay, so why do advisors and partners need to know about long-term care?
So care costs vary throughout the UK. However, these costs can be substantial, and we need to know what options are available to fund that cost. So we need to know about the various options open to clients who have to pay for care. So we need to be familiar with the products available to help fund the care. We also need to know what the impact of clients' existing investments will have on the funding of that care.
Those costs look quite substantial. How are clients assessed for long-term care?
So usually the individual is identified as needing support, and a care assessment is carried out to find out what support and assistance that they need. Now this is called the Single Assessment Process, or SAP for short, and typically involves healthcare workers and social services. There are many different types of care, from domiciliary support in the client's own home to sheltered or supported living. There's respite care, there's nursing care homes and residential care homes. And once they work out the type of care needed, the individual will then be assessed financially to work out who will pay for the care.
A term I've heard before is means test. What does that mean?
Okay, Nick, so the means test is where a financial assessment is carried out by the local authority to find out what the client can afford to contribute to the cost of their care. So this might mean that clients will self-fund if they have assets above the savings thresholds. Mostly all of a client's assets, so that's savings and investments, will be used in the assessment. There are also special rules when it comes to the client's own home, depending on their circumstances and who remains in the home when the client goes into care. However, clients should be aware that their home will generally be used to help fund the care should they not have enough funds themselves elsewhere. You can find more information on the Age UK website, where you will find fact sheets on various topics, and fact sheet 38 covers the rules around the main residence when paying for care.
I know there's rules around different investment wrappers. Are you able to tell us a bit about life assurance bonds?
Of course. So life assurance bonds are disregarded in the calculation of the means test. At one point, we did think that this was going to change when the Care Act 2014 was introduced to overhaul the rules. However, nothing changed in respect of life assured bonds, and they are still classed as a disregarded asset unless a client is taking regular withdrawals. So regular withdrawals from a bond will be counted as income by the local authority in the means test calculation.
Another term I've heard about is asset deprivation. Are you able to tell us a bit about that?
So this is where individuals deliberately give away assets thinking that the local authority will have to pay for their care. It's a very complex area and the rules can be far-reaching. So as an example, if a client decided to transfer their house into a trust, so transferring the ownership of their home to trustees, where they've got no IHT liability, this may be viewed as asset deprivation. If clients give away their cash or investments to, say, their family before they require long-term care, this may be viewed as asset deprivation. If a client invested in a life assurance bond knowing that they will shortly need care, this may be viewed as a deliberate deprivation of assets. Basically, the local authority have got to prove that the motivation behind the transaction was to avoid paying for care. And if they decide that this is a case, they will count the asset in their assessment. So in simple terms, they will convert the value of the asset into notional income and reduce what they will pay towards the care, leaving the individual or their family to fund the shortfall. And again, there are really good fact sheet on Age UK's website. And if you look at fact sheet 40, that will cover the rules on asset deprivation.
So funding care is really critical when looking at a client who needs or may need long-term care in the future. Are there any products that can help pay for long-term care?
So there are various ways to pay for long-term care. So if your client is self-funding, firstly, most of their income will be used against the costs, with the shortfall taken from capital. There are also other ways to fund long-term care. So a client can buy an immediate needs annuity to fund some or all of the costs, or they can use the regular payments from a bond, for example. And if a client needs to do some IHT planning as well, they can think about using a discounted gift plan or a loan plan to help provide regular payments. Clients can pay for future care needs by taking out what we call a later life plan, and that's an IHT effective plan that carves out a specified amount chosen by the client, which is triggered should they need long-term care. So as you can see, Nick, there are many options for clients to consider.
Definitely. You mentioned immediate needs annuities there. How is that income taxed?
So generally, payments made directly to care homes are free of tax. However, this will be dependent on how the client is funding the care. And there is more information around the taxation of our investments on TechLink. So in summary, you can see there are lots of things that you need to be aware of in respect of long-term care, from how to fund this and what products to use. And don't forget that if clients hold life assurance bonds, they do not count towards the means test, as long as the investment was not a deliberate deprivation of assets. Another thing to watch out for is if a client has got a loan plan, for example, the outstanding loan will count towards the means test because the client owns that loan. They don't actually own the life assured bond. The bond's obviously in trust and held by the trustees. So the local authority have got to prove that the motivation behind any investment that moves the asset away from the client and into trust is genuine IHT planning. Otherwise, they may view this as asset deprivation. So I hope you found this wee session useful, and you can find further information on this topic on our TechLink pages. Thank you.